Now, at some point, your RSP, of course, has to be matured. So unless you cancel it outright, basically, in which case then, of course, the whole thing will be taxable and everything else, it will mature at some point. So the maximum maturity date can be no later than the year you turn age 71. That doesn't mean that the income has to start at age 71. The actual income could actually start at age 72. In other words, you can defer for one more year. All we're saying is that you need to annuitize. You cannot contribute any more money into your RRSP from the year you turn age 71. That is the maximum amount. But in other words, you have to convert that into some kind of an annuity. And there's two annuities that you can buy. That is a RIF, which we'll talk about now, and of course a life annuity, which we may talk about in a future session and everything else. Okay, but basically, in other words, you can have your money basically annuitized the year to be 71. But you say, I want the income to start a year later. That's not a problem. But you have annuitized it prior to the year you turn age 71. So that's the most crucial part of it, okay? So when you buy a life annuity, the life annuity, of course, gives you a fixed amount of money for the rest of your life and so on and so forth, okay? So the problem with the life annuity, of course, is that's not flexible. So once we've established that, let's say you're going to get $5,000 a month, for the rest of your life, it'll always be $5,000 a month. So yes, it gives you total peace of mind, but remember that there's nothing more. So it could be subject to interest rate issues and interest risk, as well as of course inflationary risk. Because once we make this into a payout, you really can't change it. The life annuity, the nice thing about it is the total peace of mind. As long as you live, you're going to get an income and everything else. The problem with that is what you give up basically is the estate value. That basically there's no flexibility of any kind. And if you pass away and you bought a zero guarantee life annuity, there is no estate value. Basically, there's nothing left for your beneficiaries and everything. For that reason, the vast majority of people will RIF their money. In other words, they'll buy the rest of retirement income fund, because in a RIF situation, you do have the flexibility in that you can stop and go, basically take out sums of money, and if you should die, there is something left at the other end. We'll look at that a little bit in a moment. So the essential rules of a RIF are really quite basic. So rest of retirement income fund, there is a minimum withdrawal. Okay, so you must take out a minimum amount. The government of Canada gives us all the financial institutions that issue RIFs a guideline, basically an actual table. So it doesn't really matter where you buy your RIF in a sense that the minimum is the minimum regardless of, so for example, at age 71, I believe this year is 5.28%. So you must take out 5.28% times the total amount of money that you got in your RIF, and then divide it by 12, and that'll be the amount of money that you're looking at for that particular year. And then that calculation is done again next year. So January of next year, for example, how much money you got sitting in your RIF, about X amount of dollars times 5 point whatever that number is, okay, and it keeps on going. So basically, unlike a life annuity where it's fixed forever a day, basically, so you know exactly what you're getting forever. In a RIF, it could fluctuate depending on how much money and how well investments have been doing. But again, unlike a life annuity, in a RIF situation, you can invest your money in various different funds. Just like you can do with your RRSP, where you're basically, depending on your risk tolerance and everything else, you can, if you're very, very conservative, just buy bonds and GICs. If you want to take a little more risk, you can buy equities, you can buy international funds, things of that nature. So the RIF gives you that flexibility. But the life annuity does not give you that flexibility. A life annuity gives you total 100% peace of mind. Okay. What a RIF does, it doesn't quite give you total peace of mind, because if the market tanks, things go wrong, whatever it is, you could lose it all, basically. But it does give you the opportunity to be flexible in that you can pick and choose your investment options and so on and so forth. Okay. So, but you must take out the minimum. However, there's no maximum. Okay, there is no maximum, so therefore you can take out whatever you want over and above your minimum. You can certainly take out as much as you want. But remember that when you do take out anything above the minimum, it will be subject to withholding tax. The minimum is not subject to withholding tax. It's just a minimum and that's it, okay? But if you take out any amounts above that, in other words, the first $5,000 above the minimum, for example, take an extra $5,000, 10% is gone. Basically it's a withholding tax. So you do have a withholding tax issue, basically 10, 15, all the way up to 30%, basically. But the point is that there is no maximum withdrawal. If you don't want to use your own age, so you're 71, for example, and you want to use a younger age, because by using a younger age, that percentage will be lower. So, for example, at 65, the percentage you must take out is in the area of around 4%, whereas at age 71, you must take out 5.28%. That's by law, basically, okay? And so therefore, you're saying, well, I want to make sure my money lasts. So therefore, taking out 5.28% at 71, I may run out of money in the future. Okay, how do I protect myself against the possibility of doing that? Well, if you have a younger spouse, you can take it. At that age, basically. So at age 65, for example, it's roughly about 4%. So that means you've got more money sitting in the pot, you might say, to invest in, and so on and so forth. So that's one way of protecting yourself against basically running out of money. Of course, at some point you may die. Okay, you may die. So in any kind of RSP or RIF or whatever it is, okay, if you died and you have no beneficiaries of any kind, no spouse, no children, no anything, okay, then obviously it's going to be paid to your estate, and it will be taxed to your estate at whatever marginal rate your estate happens to be at the time that you died, okay. And so the end result is that if you don't have a beneficiary of sort, or you do, but you decide to leave the estate, not a good idea, okay? Because, like I said, it could be quite a substantial amount of tax involved and everything else, okay? However, there is remedy, okay? There is remedy. So if you do have a spouse, then spousal rollover comes into play. And that rollover could be any age, okay? Any age. So if you're 71 and you died and you have a 50-year-old spouse, that money can be rolled over to that 50-year-old spouse. You're 95 years old and you have an 80-year-old spouse. The money can be rolled over to the 80-year-old spouse. It doesn't really matter. So age is not a consideration here. The point is, if you have a spouse, the money can be rolled over to your spouse. So therefore, once again, the tax will be deferred, you see, until your spouse passes away, basically. So now the money that's left in your RIF or in your RSP now belongs to your spouse. And they will be taxed according when they make their withdrawals. Basically, they will be taxed accordingly. So even if your income is actually started, so you're now 75, and you can get a check all along, but there is a lump sum of money, let's say, sitting in your RIF. That lump sum will be moved over to your spouse, totally tax-free, and then of course your spouse will begin to get an income, and he or she will be able to take out money on whatever period of time that they want. Again, no later than age 71, same rules, and they will pay tax according to their marginal tax rate. Okay, so that's one big issue is having a spouse. The second one, of course, is having a child. Okay, a child or children younger than 18. So if you have a 10-year-old son or something, whatever, and the child is a beneficiary, and you've got RIF money or you have RSP money sitting in there, your child could in fact be named the beneficiary. However, what they'll do is they'll buy an annuity for that child to age 18. And so therefore then the money will be rolled over to that child. An annuity is purchased to age 18, so it's a limited annuity based to age 18. And then the child will pay tax according to the income that they in fact receive at their marginal tax rate, but not your marginal rate. Okay, it'll be your child's marginal rate. So therefore, once again, if you have a dependent child younger than 18, you could roll that money again, totally tax free to your younger child. Okay. Also, if that child happens to be older, okay, over age 18, so an adult basically, and they're mentally or physically disabled, in that case, once again, you can, what they'll do is they will roll over to that disabled child. They'll buy an annuity for that for that child, and that child will then, so they'll buy a life annuity or something, an annuity for that child, and then that child will receive an income on a monthly basis, let's say, and they will pay tax according to their marginal tax rate. But the point is, okay, that in all cases here, whether it's spousal rollover, child, younger child, or mentally or physically disabled child, the rollover provision applies. So that way you do not have to worry at your date of death that you'll have a big tax bill because it is rolled over. So the tax can be deferred further to your spouse, younger children, or mentally physically disabled. And the last thing, and some restrictions apply here, of course, so it's beyond the scope of this lesson, but if all, at the end of the day, you do have that mentally physically disabled child, you can actually put that money into an RDSP, a Registered Disability Savings Plan. We may be talking about that in a subsequent video, but basically a Registered Disability Plan is designed to hold money for a disabled child, basically, so your RSP money could in fact be rolled over to that dependent child. So rather than buying an annuity for that child, that child may already have a Registered Disability Savings Plan, and subject to maximums and everything else, could be rolled over again on a tax-free basis. So these are all things that could be done in the event that the maturity, or in the event that you prematurely pass away. What happens to that money?